Okay, we on? All right, Chapter 25, Transfer Taxes and Wealth Planning. Transfer taxes is mainly what we're going to talk about. That's the gift tax and estate tax. The gift and estate tax are in a different section of the Internal Revenue Code. It has very little to do with the income tax section. I mean, there's some cross sections when we're dealing with gifts and charitable contributions, or gifts to charitable organizations and some other areas, but I mean, the two have little to do with each other. And if you think about it, if you're gifting real or personal properties to someone, or you're bequeathing this property to someone in your will, well, the income it took to produce that or purchase that property, or if it's just money, it's just money, was already taxed maybe years ago, maybe even decades ago. So, you think taxes end at death, but not really, at least and the book kind of gives you the impression that this is only for the super rich, but as we discuss this, you will find out that that's not necessarily true. So don't get that impression. Don't get the impression that this whole transfer tax system is fair, because maybe it's not. I mean, there's been quite a bit of discussion about abolishing transfer taxes. And we'll talk about, why these transfer taxes are a problem. Okay, so just get out of your mind any misnomer that, this is a tax on the rich. And, this idea that, let's tax the rich, stick it to them, because that's not necessarily true. Okay? All right, and so I just want you to know that we're I'm trying to keep this fairly basic, because, normally when I got my master's in accounting, and then when I went on after law school and got a master of law in taxation, these were the gift and estate tax was a separate 3-hour course, or being on the semester a semester system, I guess it would be a 4-hour course if it were quarter system. So this is a whole new course. This is a whole different course. So to cover this in 1 week is kind of unfair, but I do want to give you an overview of this, because if you're going to work at a small to medium-sized accounting firm, there's a chance that you may be filing a gift and or estate tax, Form 709 or 706. So you kind of need to know something about it. And, if you get into doing this, you'll obviously get the exposure that you need, hopefully with the support you need to be able to do this. But at least you'll be able to know with some intelligence about what's being discussed. All right. And so the gift and estate tax is a unified tax. It's a unified tax system. Okay? And so in figuring out the tax, you consider not only prior gifts, but assuming that all property hasn't been gifted at death, and there's property still in the estate that's bequeathed at death, it considers the gifts made during the lifetime of the decedent, that's the dead person, and then whatever's left that's being bequeathed to the beneficiaries in the will. And the book, again, I guess these guys aren't lawyers. They don't have a law degree. So I kind of cut them some slack. But just so you know, sometimes people die without a will. Maybe many times. Hopefully not the wealthiest of people who might be subject to the gift or estate tax. Well, mainly the estate tax. But if they die without a will, then there's what we call the laws of intestacy, and these are statutory requirements of how to distribute property of a decedent when they die without a will. Okay? So it basically tells how property of a decedent will be divided if they die without a will. And it's required for the administrator of the estate to divide the property as such, per the law. So, anyway, just wanted to point that out as well. There's some other things in the chapter that I caught that weren't quite right, and I hope I mention all of them. All right, so they have a common tax rate schedule. There is a unified credit, and that unified credit is pretty large. It's in 2015, it's $5.43 million. And really the unified credit and the exemption equivalent are two parts of the same piece. The unified credit is simply the exemption equivalent, which is the 5.430, 5,430,000. And the unified credit is simply the exemption equivalent times whatever the taxable percentage is. Okay, so just simply multiply 5,430,000 times 40%, and that's your unified credit. And notice that again, this is based upon cumulative transfers over the lifetime of the decedent and at death, even after the decedent. So note that you have some things to offset this gift and estate tax. First of all, you have an unlimited charitable deduction, and so you can make unlimited charitable donations, unlike what you can do in the income tax. Remember, you have some limitations there. Here you don't. You have an unlimited marital deduction for transfers to a spouse. As a matter of fact, many times in common law states, what do I mean by common law states? Well, common law states, I think Oregon's a common law state. pretty sure, check my smartphone, pretty sure Washington is a community property state. So hold on, let's just make sure I'm speaking the truth here. My phone's being stupid. All right, we'll get out of this. Community property states. Okay, so Arizona, California, Idaho, Louisiana, Nevada, Mexico, Texas, Washington, and Wisconsin are community property states. What that means is if you're married and you earn income, half that income is yours and half of it is your spouse's. Okay? So it's automatic in community property states. In common law states, such as Oregon, that's not true. The person who earns it owns it. And so you can have this situation, especially where you have, let's say, an executive, was out there working away for several years, and then his spouse or her spouse is at home slaving away in the kitchen, or just keeping things in order back at home. Okay. In that case, you could end up with the executive having a fairly large estate and the other spouse who stays at home having a fairly small estate. And in that case, one of the things that you try to do is even out the two estates. And you'll see why here, probably not today, but definitely tomorrow when we talk about estate tax. It's best to even out the estates of the spouses for gift tax and estate tax planning purposes. Okay? So, fortunately, you have an unlimited marital deduction, so you can transfer from the executive spouse to the home-based spouse enough to even out their estates. All right, so here's your federal gift tax formula. First, you have to figure out your taxable gifts for each individual donee. Notice, first of all, that you have the option, which we'll talk about here in a minute, called gift splitting by spouses. And so this fits in with the annual exclusion, which is $14,000. And this doesn't have to be cash. This can be any kind of property. But if it's any other kind of property, the value of that property would have to be $14,000 or less to meet the annual exclusion. Okay? And so we'll get into this here in a minute, but just giving you the details of the calculation. You have your gifts election to split the gift, and then So, if you made a $14,000 gift, well, let's say you made a $28,000 gift. Okay? And you and your spouse agree to split the gift. Well, since you're splitting the gift, you subtract 1/2 of that gift. So you'd subtract $14,000 from the $28,000 total gift. You got your annual exclusion, $14,000 per donee, et cetera, et cetera, et cetera. Marital and charitable deductions, again, they're unlimited, so that would be equal your current taxable gifts per each donee. And then in part 2, you take the total current taxable gifts. So for each donee, the current taxable gift for each donee. And then to that, you add the prior taxable gift to come up with the cumulative taxable gifts. And then you multiply that times the current tax rates. That equals the cumulative tax, and then from that you subtract the current tax on prior taxable gifts and the remaining unified credit to come up with gift tax payable. Okay? And so the gift tax is levied on individual taxpayers for taxable gifts completed during the tax year or during the calendar year. The transfers that are subject to gift tax are these inter vivos gifts, which simply means gifts made during the donor's lifetime. Okay, the donor is the person giving the gift, the donee is the person receiving the gift. It also includes lifetime transfers of property for less than adequate consideration. Certainly in a gift there is no consideration, but even where there's inadequate consideration, there is at least a partial gift. Now this transfer is subject to gift tax. Once the gift has been completed, that requires two things: that the donor relinquish control of the property. So if they have any incidences of ownership still to where they could revoke the gift, it's not a completed gift. Number 2, the donee has to accept the gift. So those are the two elements that you have to have for a gift to be completed. Now notice, again, back at the top, this is levied on individual taxpayers. Meaning, if you're married and both you and your spouse give gifts to donees during the year, there's no such thing as a joint filing of a gift tax return. Each of the spouses have to file their own separate gift tax return, which is, I don't know, bad for them, great for the CPA doing the work, right? Because it means double the work. Now, as far as valuation, the amount subject to gift tax, possible gift tax, is the fair market value of the gift at the time the gift is given, the date of the gift, right? Well, if it's money, that's easy to figure out. If it's publicly traded shares, that's easy to figure out. But, you know, many times there are things that are given that aren't so easy to figure out. Shares of a privately held company, for instance. How do you figure out the fair market value of those? So anyway, I'm not saying, what I'm saying is it's the fair market value is easy to define, it's hard to apply. And so fair market value is defined as the price at which such property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell, and both have reasonable knowledge of the relevant facts. In other words, they, in determining fair market value, they would look at what two unrelated parties would bargain for. Remember, under gift and estate tax, usually you're dealing with close family members. So it's not a whole lot of arm's length going on. I mean, if you have what's called a temporal interest, either what they call a life estate or a remainder estate, then you've got to use your value tables much like you would with an annuity or anything like that. So anyway, they use discount factors for estimating the value of remainder interest. So if you look at page 8, Exhibit 25-4, and they have an example in here which determines the value of the interest rate. And so future interests are valued at present value, calculated by estimating the time until the present interest expires. Present value calculation uses the 75/20 interest table or interest rate published by the Treasury. And so that's what that 25-4 is that 75/20 interest rate. Let's see what else I want to talk about. Couple of other things. They talk about these future interests. What you can have, again, are life estates where, let's say, you pay mom. You have this property that's put into this, usually a trust. Now, this trust can be created during the donor's life or at death, so it can be inter vivos or testamentary, meaning in the will. And what you can do is, let's say, if the donor or decedent decides to create this trust and set up, put property into this trust, that property is called the corpus. And let's say this trust has a life estate for mom. And so what that would normally say is that it would pay mom the income on the corpus of the property during her life. So that's the life estate. Now, so what do you have there? Well, as income is paid every year, that's a gift. Let's assume this is an inter vivos trust by the donor. Every time that the donee of this life estate receives income, that is a gift. Now, you've got a remainder interest there too, right? Let's say it says income for life of mom, then the corpus, remainder of the corpus goes to Junior. Okay, so Junior has a remainder interest there of the corpus sometime in the future. He doesn't know when. So that's how you have to figure out this remainder interest, is using these discount factors. All right, so here we have an example. Ben transfers $1 million of stock to the Junior Trust and directs to pay income to Junior for life and remainder to Georgia. How is the life estate valued if Junior's 5 years old at the time of the gift and the Section 7520 rate is 5%? So anyway, what you would have to do is figure out his age, 5, and go to the table and where his age and that rate merge on the table is the rate that you would use, and multiply that, this 0.0458 times 1 million, and so the remainder is valued at $42,580. And so to figure out the life estate, you take the amount of the trust, the 1 million, and subtract the 42,580. So the life estate is valued at $957,420. Now again, you can exclude certain gifts from gift tax. Certainly if it's an incomplete or revocable gift, you have no gift at all, so it's not subject to gift tax. If you have a property settlement in a divorce, that is not considered a gift. That is considered, or child support. Those are support obligations or debts, not a gift. Contributions to political parties or candidates are not gifts. Here's a big one. Paying the medical and educational expenses on behalf of an unrelated individual. Now notice it says unrelated individual. Trying to find this in the book. Let's see. I'll find it at some point, come back to it. It's funny when you want to find something, you never can, right? Moving on. And of course, the thing that's not subject to gift tax is your annual exclusion. So you can make gifts up to $14,000 to a donee. So it's $14,000 per donee per year. Now that's the amount in 2015. This amount tends to go up, so it may be more in 2016. So one of the things that most estate planners advise to do as part of a way of reducing a person's taxable estate is a concentrated effort to gift away property over several years. I mean, if you've got, let's say, you've got a $10 million estate, you've got, I don't know, 14, let's say you got, let's think about this. Let's say you got 5 kids, you've got 10 grandchildren. How much can you give away in 1 year without being subject to gift tax? Well, 14,000 times 15. That's a lot, right? That's $200,000 that you can give in any 1 year to those family members and not be subject to gift tax and not have to file a gift tax return. Here's the other thing about gift tax returns. Note that this has nothing to do with how much gift or estate tax you owe. It's not like income tax where you have to owe a certain amount or you have to make a certain amount. You have to owe a certain amount with corporate taxes, right, in order to file. Here, it's about whether you made gifts in excess of the annual exclusion. Just one donee over the $14,000 threshold causes you to have to file a gift tax return, even though you're probably not going to owe any actual gift tax because of, all the other things, the unified credit and all that junk. Okay? Why did they make taxpayers do this? Well, it's the government's way of keeping up with the cumulative gifts of individuals. Big Brother. It's kind of invasive, if you ask me, but hey, who am I? Now note that gifts of present interests qualify for the exclusion. So if you give a remainder interest in something, that is not going to qualify for a gift. And so the present interest is a right to own and enjoy the property currently. So let's say you put property into a trust and the trust says that income generated from the trust is given to a certain family member. Certainly when they receive that income, that's a present interest But as far as the corpus is concerned, well, let's say it's a revocable trust. So the donor has the ability to revoke the trust at any point. That's not a present interest. The corpus isn't. Now, certain gifts of future interest are eligible for the exclusion. These are gifts of future interest placed in trust for a minor. These are what's generally called either UGMA accounts. That's Uniform Gifts to Minors Act. And there's another one called UTMA, Uniform Trusts or Unified Trusts to Minors Act. And so, anyway, if you set up one of these gifts or trusts and you put money into it, even though it's a future interest, usually it says that, usually these are minor children, first of all. And so minor children cannot receive a present interest in a gift because they're minors. And so usually what you have to do and what you're required to do in order to get the exclusion is set it up and say that that the minor can't receive the corpus of the trust until they turn 21. And so even though that's true, it's a future interest, you the donor can still make this gift, and even though it's a future interest, you can qualify for an exclusion as long as it meets the UGMA and or UTMA requirements. Calculating the taxable gifts, recall you get if you're married, you get the chance to split the gift, and so this increases the likelihood that the gift tax will be reduced. I mean, if the overall amount, think about this, if the overall exemption equivalent is $5.430 million, and this is based upon individuals, not couples. Essentially, what you can have here is if you do it right, and what's 5.430? Well, $10,860,000 that is exempt from gift and estate tax, right? If you're married, and if you set it up right. Now note, in order to gift split, the spouses have to be married at the time of the gift and not divorced or remarried during the year. Duh. Both spouses must consent to the election by filing a timely gift tax return, which is April 15th of the next year, by the way. And the annual election applies to all completed gifts only. Again, marital deduction, any gifts made to a spouse are unlimited and not subject to gift tax. charitable deduction, no percentage limitation like you have with income tax. And then you probably get an income tax deduction on top of that. Note that the charities that fall under this deduction include some foreign charities. If you recall, for income tax purposes, it has to be a domestic charity and, of course, meet other requirements. So you could have a situation where you have a foreign charity that meets the charitable deduction, is qualified under the gift tax, and so you would get a charitable deduction but not be able to get an income tax deduction. And note that if you make a charitable deduction, no gift tax return is necessary as long as it's a gift of the entire interest. And so, again, computation of the gift tax, you take your prior taxable gifts plus current taxable gifts to figure out your tax on the cumulative gifts. And the purpose of that is to increase the tax base and thereby increase the marginal tax rate applying to current gifts. And then from that, you subtract the gift tax that has already been calculated on the prior taxable gifts. This prevents double taxation of the prior taxable gifts. Note that even the prior taxable gifts are the tax calculated, it uses the current rate schedule. That's kind of weird. And on top of that, you also subtract the unused unified credit that's calculated using the current rate schedule. So we have an example here. It's fairly basic, and I want to keep this as basic as possible. Brian made a $7 million taxable gift this year. Okay, pretty basic. Previously, he made a $1 million taxable gift that was offset by the unified credit. So he didn't owe anything on the $1 million prior taxable gift. What amount of gift tax is due on Brian's gift? Well, you know right offhand that his cumulative gifts are $8 million. And if the exemption equivalent's only 5.43, some of this is going to be subject to gift tax, right? Presently. So anyway, how do you figure this out? Well, the tax on $8 million is what? 8 million times $40. Is that what that's saying? Go back to my numbers here. Trying to figure out where they come up with the tax, $3,145,000, because I come up with $3,200,000. Oh, okay, I got it. It would be $7 million times 0.4, which equals 2,800,000. And to that you add, I'm looking at exhibit 25-1 on page 3. To that you would add the 345,000, which is the tax on up to 1 million. So that's 3,145,000. Okay. I was trying to figure out where they got that number. And then from that, you would subtract the 345, which is the current tax on prior taxable gifts. And then also you would deduct the 1,772,000, which is your unused unified credit, right? How can you figure out your unified credit? Well, you simply take the difference between 8 million and 5.43, your exemption equivalent. So you've got 2.57 million over the exemption equivalent that's subject to gift tax, and then you would take and well, let's see. Oh, okay. No, that's not right. It would be the 5430 minus 1. Yeah, well, it's simply the $2.57 times 40. So that's where they're coming up with that number. So that's the actual amount of tax that would be due by Brian. So anyway, that's a fairly, and I say fairly, simple illustration of figuring out gift tax. You know, this can certainly get into some complications, and I think they have some examples in here which include multiple donees. You can certainly look at those examples if you want to, but certainly I won't be asking anything quite as complex. That's not my intention in covering this chapter. This is just kind of a survey of gift and estate tax. So anyway, next time, which is tomorrow, I'll go over the estate tax and then talk about some gift and estate tax planning strategies.